Thank you so much for coming. My name is Stephanie Ruhle. I'm morning anchor with Bloomberg Television. I am thrilled to be here and honored to be with these two gentlemen, Jason Cummins of Brevan Howard, and the one, the only, Nouriel Roubini. So clearly, this is going to be informative and entertaining with both of my partners here. Gentlemen, I want to start, let's just take a snapshot. The health of the global economy on a 1 to 10 scale, 10 being the healthiest, 1 being the absolute pits. Where do you put us?
Do you want to go first, Nouriel? I think he's going to choose a number lower than my number, so it's going to be like the Price is Right without going over. I'd say a 6 and improving.
6 and improving.
6 and improving. 6 and moving up.
Hold on, why?
I think that you see a number of forces in the global economy that are improving. We're going to talk, obviously, about many of the geographies and the specifics about what's going on in the macro, but I think the essential metaphor for many of us that we found most persuasive in thinking about the recovery from the great financial crisis is that it would take 5, 6, 7 years to be able to delever and grow and begin to put some of the tensions that we saw that had built up for such a long period into the rearview mirror. And it may not seem like it, but it's been 5 to 7 years, depending upon how you mark time in each of the economies. The U.S. Housing economy began to crater in 2006, and we're already in 2014. So you've seen a lot of healing in major parts of the economy, and so I think things are better than at par and probably moving up, just owing to the healing effects of time. A lot of policymakers have done a great job. They're continuing to do a great job in helping the economies along. By no means is everything fixed, but I think things are moving in a positive direction.
Do you have a favorite policymaker?
A favorite policymaker? I think we'll touch on China a bit. My favorite now would be Ben Bernanke. I think my favorite in the future may be Xi Jinping. I think people may look back on his tenure as leader of China as perhaps one of the most important people of the 21st century.
Dr. Doom, 1 to 10, where do you put the global economy?
Can we go negative
yes.
For Nouriel?
No. Well, if you ask me, I'm reminded of that story of John Major, used to be the Prime Minister of Britain. So he once went to the Soviet Union and asked the Soviet leader, how's the Russian economy doing in brief? And the Soviet leader said, good, in one word. And he says, can you elaborate maybe in a couple of words? And he says, not good. So if I had to say in one number, maybe I would say 6. In 2 numbers, maybe 4 or 5. Meaning things are improving, but I see still a bunch of downside risk. I mean, the things that are improving, of course, are that the risk of a Eurozone breakup, Italy and Spain losing market access is lower. The risk of a US fiscal crisis, government shutdown, debt ceiling fight is lower. Abenomics so far is working, and you're not going to have a debt crisis in Japan. The risk of maybe deflation that are reduced by unconventional monetary policy, ZIRP, zero interest rate policy, QE, quantitative easing, CE, credit easing, FG forward guidance, and some of the geopolitical risks are also lower. The risk of a war between Iran and Israel on nuclear proliferation, given there is an agreement between the great powers, and also the risk coming from a Middle East that is totally a mess. If you think an arc of instability starts in Maghreb all the way to AfPak, why these countries are geopolitically maybe important, but unless there is a shock to the supply of gas, oil, and energy, they don't matter from an economic point of view. So those are the receding risk, and things are improving. But I see also a number of clouds over the horizon, and we can discuss which one of them.
I want to break down the risks. Recently, Dr. Roubini put out the 6 largest risks facing the global economy, and we're going to break them down. Nouriel, let's start. Hard landing in China. Want to elaborate?
Well, I spent a few days in China just a couple of weeks ago. I had a chance to meet the governor of Central Bank Zhu, the finance minister, and many others. And last fall I was in Beijing, and our delegation met even the president Xi and the Prime Minister Li. I think there are 2 views about China, and both of them, in my view, probably are incorrect. There's a consensus that says China is going to keep on growing 7.5%. It's going to be a soft landing. And of course, there are the Jim Chanuses of the world who say total hard landing, 3% growth, economic and financial meltdown, even instability, revolution, politically and otherwise. The Chinese leaders know that their growth model is unsustainable, too much fixed investment, too little consumption. The reform that they suggested in the third plenum and now go in the right direction of rebalancing the economy from fixed investment to consumption. But I think there are two constraints that to me are going to be important. They're going to imply slowdown of growth, much less than 7% towards 6 and then 5 in the next couple of years. So not a hard landing, not a soft landing, but I would say pretty rough and bumpy landing. The first one is that the interest groups that are against the reforms because they benefit from capital-intensive growth are very powerful. State-owned enterprises, provincial government, the SPVs, the PLA, the state sector, while those who are going to benefit from consumption-oriented and labor-intensive growth are politically weak because it's not a democracy. Secondly, when I was in November, both the Prime Minister and the President insisted that they need 7.5% growth because they want to double GDP within the next decade. If you take 7.5 compounded for 10 years, it goes to a double of GDP. But every time growth goes towards 7% for the last 5 years, what have they done? They've done another round of credit-fueled fixed investment. That means more bad assets in the banks and the shadow banks, more and rising NPLs, more bad investments from real estate to infrastructure to excess capacity in the industrial manufacturing sector, and more debt and leverage in the private and public sector. The ratio of leverage in China today between private and public is 240% and rising. So there is a dilemma. If you're serious about reducing the leverage ratio, you have to grow less than 7%. But if you have a political objective of growing 7.5%, the leverage ratio can go only higher because you need new and new rounds of credit-fueled fixed investment. 4 years ago, we take 1 yuan to create 1 GDP unit. Today, it takes 4 yuan of credit to create 1 unit of GDP. So the marginal product of this credit creation on output is lower and shorter, and the effect on leverage is rising bad assets, bad debts, and bad investment. And therefore, I see things worse than the market expects. Not a real collapse, but I'm certainly below consensus in my view of China.
So I get to the same conclusion in some similar ways.
It's not entertaining enough.
I'm gonna try. I'll try. So I think you want to talk about 3 things when it comes to China. The first is that there's never really been, in my experience, professional experience as an economist, a greater disconnect between the rhetoric and the reality of what's going on in a place. And what I mean by that is the following. A few years ago, if you were to discuss China at a panel like this, people would have said the place is going down the tubes for the following reasons. A fixed asset investment model, which is based upon getting lots of physical capital into state-owned enterprises that are going to inefficiently manage it, have a rate of return of 0, no profits, and in all of historical experience, whether it's Russia, Japan, Korea, business models like that as a country have failed. The second thing is that there's this credit bubble. Nouriel mentioned that the credit multiplier has made it so that when you try and pour more credit in that economy, it's not creating as much output as it has in the past. Third, people would have mentioned corruption. And lastly, people would have mentioned, which Nouriel didn't mention, a demographic time bomb. The fact of the matter is the Chinese leadership are working on all 4 things. So if you had taken the panel a few years ago and you walk it forward, things are actually much improved, at least in terms of the policy thrust in all those areas. They're moving away from the state-directed investment model. They're actually really getting very serious about dealing with credit problems. Now, they have to deal with them in a way that doesn't cause a giant blow-up. They're also dealing with a situation that's very serious with corruption, pretty effectively, at least so far. And in terms of the demographics, they've gotten rid of, or slowly modifying, the one-child policy, which kind of guaranteed them some very serious difficulties going forward. I think the second point to realize is that this can't be done without causing significant problems. And I'll just focus on the corruption angle a little bit. If you have a whole kind of business model for a country designed around essentially not perhaps kleptocracy, but kind of specific oligarchies allocating capital and getting benefits from it, and then you come along and rip that out, as Xi Jinping is doing, that's going to cause a lot of disruptions in economic activity. If we used to get together and trade presents and go out and invest and steal things from certain companies, that's going to be frowned upon now. And you're going to see over the next year or 2 economic activity really get put on its back foot as a consequence of people going to jail for the prior way of behaving. I think the thing finally to keep in mind about China is not to focus just on the fact that they have problems. Just focusing on problems is, for me, not the right way to think about it. You want to think about whether the ratio of problems to good things happening is going down over time. Problems are definitely growing, but you want the denominator of my little rhetorical ratio here to be going down over time. And in my view, at least qualitatively, the good stuff that's happening in the denominator with the reform of the business model, going away from fixed investment, reforming the credit sector, reforming corruption, and getting rid of or moving away from the one-child policy, that's a big increase in that denominator, and that's pushing down this ratio over time. There are going to be lots of problems. Just to end on a bit about Mr. Chanos. Mr. Chanos famously was very, very bearish about China. If you go to Beijing now...
He doesn't believe anything that comes out of China. He doesn't believe in one piece of data. I think it's all hocus pocus.
So the great thing about the Chinese is they're incredibly, incredibly entrepreneurial. And just to give an example of that, they now have Chanos tour of Beijing, where they'll take you on all the spots that Chanos says are going to blow up China in order to try and make it just a reductio ad absurdum of what's happening in the most bearish people's minds about what's going on with China. And I think that a balanced view is to look at that ratio that's going down over time. More good things than bad things are happening.
All right, let's look at the next risk. Rates rising too soon.
Well, we know that the Fed started tapering, and last year even just talk about tapering led to a taper tantrum, long rates going from 1.5 towards 3, money flowing out of emerging markets. So it led to volatility in financial markets. Today, the tapering is priced in by the market, and of course the uncertainty is on when the Fed is going to start raising rates, the first rate hike date, and then how fast they're going to normalize rate from 0 to a neutral of 4. Now, there's a risk of starting too soon, too fast. There is a risk of doing it too late. Why they may start sooner and do it faster, I would say there are two scenarios. One I don't think is very likely. And the first one is, of course, if suddenly the labor market is tighter than they believe, and then the growth recovery leads to an acceleration of inflation, they are behind the curve, they might start sooner and then hike faster. If you look at the yield curve, the short end to the middle end of the yield curve is not pricing in the Fed starting sooner and faster. I don't think that's a big risk because there are lots of fundamental forces why slack in the goods and labor market and even in commodity now implies that inflation is going to rise only gradually in the United States. But I think that the different risk is the following one. Under Ben Bernanke, the Fed became a collegial democracy. It's not anymore the kind of monarchy absolute that was under Alan Greenspan. And Janet Yellen, she used to be my boss when I was in the White Council of Economic Advisors. She was the chair. She's by nature a very consensual person. So she may be very dovish, but think about the composition of the FOMC. Of the 7 members of the board, 4 of them now are gone. Ben Bernanke, Sarah Raskin, Elizabeth Duke, and now Jeremy Stein decided to go back to Harvard. 2 have been chosen, new, they have to be confirmed, Neil Brainard, Stan Fisher. I would say both of them, I've known them for 30 years. They're a notch less dovish than Janet Yellen, and we'll see who are going to be the other 2 that have to be chosen. But if you look at the new voting members of the FOMC, you have 3 new hawks in the committee voting. One is Plosser, one is Fisher from Dallas Fed, the other one is Mester, used to be the advisor of Plosser at the Philly Fed, and now is the new head of the Cleveland Fed. And only one of the hawks is out, Esther George. So if you look at the composition of the FOMC, and you saw it in March with Janet Yellen trying to be dovish as part from the slip about the 6 months, while the ACP dot essentially estimates being more hawkish. What's happening is that the median FOMC voter maybe is not less dovish, but the mean one is with the new hawks entering the committee. Over time, the change in the composition with more hawks, with Stan Fisher, who doesn't believe in forward guidance, was slightly less dovish than Janet Yellen, may imply that actually the speed of normalization might be faster than markets are pricing in right now.
Jason, Fed could raise rates too soon, recovery gets cut off. Are you concerned?
So I think you want to unpack the reason why rates might have to go up. If rates are going up because the economy is doing well, it's probably a pretty high-class problem, and the argument between a Stan Fisher and a Janet Yellen about whether to do liftoff in one quarter or the next quarter, I think it'll be interesting for people who focus in intense detail on things like Nouriel and I. That'll be interesting to us, but for the broader economy, it won't matter much because things will be going along well enough. I think the real issue for me is that investors and I think people in business and in households They probably put too little weight on the upside risks to either inflation or growth that would make it so that the Fed would be behind the curve in a way that would make it so that you'd have to have a discontinuous adjustment in interest rates, which could be quite disruptive. So if you go back in history, in 1994, the Fed got behind the curve, had to do intermediate moves of 50 basis points, had to do at one time an increase in interest rates of 75 basis points. And it ended up, if you looked over the whole cycle, that they averaged increasing rates just by 25 basis points each meeting. But the fact of the matter is that was very disruptive. It blew up Mexico, it blew up a brokerage in the United States, blew up Orange County, because people had made a lot of decisions by looking in the rearview mirror, and they had predicated their outlook on the idea that the future would be very much like the past. I don't rank as like hugely probable that we have an inflation shock or that growth is in the high threes such that we're so obviously behind the curve you have to act quickly. But the fact of the matter is I think that those odds are probably higher than what's in the marketplace. And I can give you one example, which is before I left the Fed as a senior economist in 2003, I was running the forecast, and we said inflation would stay in the low ones. In the event, from 2003 into 2004, inflation rose by more than a percentage point. So you went very, very quickly in something that was a very big surprise, and it ended up not being that disruptive to raise rates in June of 2004. But if you saw that kind of acceleration in prices today, in an environment where people think it's absolutely metaphysically impossible for inflation to go up just by a few tenths by the end of the year, I think that could be very disruptive indeed. And very disruptive in some of the markets that we focus on a lot because people have levered up, they've gotten into some of the same credit structures and other structures that they have been in the past. And the idea that the Fed might have to actually put real rates positive faster than people expect, that could be very disruptive indeed, not only for the US, but for the rest of the world. And you saw that with the taper tantrum last year. A lot of people had worse than a tantrum as a consequence of these sorts of spillovers and global connections in financial markets that could make it very rough for Mr. Rajan to be running in India if the US has to have positive real rates sooner than people expect.
All right, then let's say Fed raises rates too late, causing an asset bubble.
I think that's actually a more likely risk than raising rates soon because the economy is growing slowly, unemployment rate is high, inflation is low. And if you think about it, we've had 5 years of zero policy rates. We've had QE1, QE2, Operation Twist, QE3. QE3 is not going to be over until either October or December. And the Fed is going to stay on hold, I would say, at least through the middle of next year. I don't see them hiking rates in April, June, July, maybe even later, given the economy. And then they've officially said, based on the median FOMC vote, that it's going to take them at least 3.5 years to normalize rates from 0 to 4. 4, less than the previous peak of 5.25, less than the previous peak of 6.5. So last time around, think about it, it took them 2 years, measure pace, pre-announce, 25 basis points every 6 weeks, too little, too late, slow, measure pace, between 04 and 06, 2 years to go from 1 to 5.25. They caused the biggest subprime bubble, housing bubble, credit bubble, equity bubble, financial bubble, and that boom and a bubble eventually led to a bust and a crash. This time around, after 5 years of zero rates and QE, they're going to start only in the middle of next year. It's going to take them 3.5 years to 4 years to go from 0 to 4. So Janet Yellen says, when she was in the confirmation hearings, she was asked, do you have a bubble today in the United States? And the answer was no. And I would agree, probably today there is not a bubble in the equity market or credit markets. But the question is not today. Given this very slow pace of normalization, the question, what's the risk of a bubble 12 months from now or 24 months from now? Now, Janet Yellen will tell you, we have 2 goals and we have 2 instruments. One is economic stability and recovery of strong growth of jobs and the economy, avoiding low inflation, and one is avoiding bubble. But we have 2 instruments, monetary policy for the real economy and macroprudential regulation and supervision of financial market. Macroprudential is going to avoid bubble. But there are plenty of people within the Fed, starting with Jeremy Stein, who say macro-proof is not going to work. It's untested. In the past has not worked. You impose leverage ratio on one part of the banking system. Zero rate liquidity go into other parts of the banking system. You impose leverage ratio for all the banks, and the liquidity is going to go to the unregulated, less regulated shadow banking system. So the only instrument that enters in all the cracks of the financial system is the interest rate policy. Now think about it. Suppose it's right and macro-proof is not going to work. You have one instrument and you have two goals. Damn if you do, damn if you don't. Because if you exit slowly because the real economy justifies it, you're going to cause the mother of all bubbles. And if instead you decide at some point to use monetary policy to prick that bubble, you'll have a bond market rout and you'll have a hard landing of the economy. And more than tapering, more than first rate hike, the biggest dilemma that the Fed, the BOJ, ECB, SMB, BOE, Riksbank, and other major central banks in the world are going to face next few years is how to achieve economic recovery and financial stability in a world in which policies are near to zero because the recovery is anemic, but you're building up through these easy policies massive asset bubbles down the line. I think that's going to be the biggest dilemma that all major central banks will have to face in the next few years. And the risk is that they exit too late and they cause the mother of a bubble. And we saw what happened last time around. Every boom and bubble eventually leads to a bust and a crash. Now, it's not a risk for the next 12 months, but 24 months from now, I would worry about that one.
Concerns around an asset bubble if the Fed rises too late?
I think that's a huge risk. If you take the other side of my inflation point, inflation rising faster than expected is a big problem because people have not properly weighted that, I think, in their forecasts. If inflation stays low and you have to have real rates for such a long, prolonged period of time, going into nearly a decade, you're talking about creating exactly the conditions that Nouriel describes for an asset bubble. And I don't know what policy will look like in an environment where inflation stays closer to 1% than 2%, and asset bubbles grow to something more obvious, where the froth becomes more visible to everyone. And I don't know the answer to that because they don't know the answer to that. It's certainly the case that in their view, the focus on macroprudential issues is inversely proportional to the shrinking of the output gap. So as the output gap gets smaller and smaller over time, they're going to focus more and more on macroprudential issues. But if you have no inflation in wages or prices, or if there's lots of slack in the global economy, I don't know how policymakers are going to weight those things. The essential question will come down to things like, well, there's lots of slack in the global economy, so China is not growing particularly dynamically. So goods prices around the world and input prices, especially ones related to commodities, will be very weak. Is the US really going to keep real interest rates at zero or negative for 10 years because China isn't growing as fast as it has been in the past? I think that will be a real policy dilemma that will be very, very hard for people to deal with. The idea that you have an asset price bubble, but you're making progress on both sides of the dual mandate in lowering the unemployment rate and raising inflation even in just the right direction, let alone a lot. I'm not particularly worried about that because rates will go up. That'll help cure your macroprudential issues, fill in the cracks, and you'll slowly over time be able to still achieve your dual mandate kind of objectives. But to the extent that the US economy is kind of borrowing some of the global slack, and we have to tune monetary policy for the reserve currency to that, I struggle to understand where we'll be in 3 years if that outcome happens.
I want to pop back to China.
Yep.
You're concerned land disputes could cause military intervention and really a political issue.
Well, one of the things I'm starting to worry is that people think about the geopolitical issues that can affect the global economy. Of course, Iran, Israel, the Russia, Ukraine, Cold War could become a hot war. Of course, the mess in the Middle East, even North Korea. But if I think about the biggest, geopolitical issue of our time is going to be how to maintain a peaceful rise of China. And I was at Davos at the World Economic Forum this year, as I always go, and I was actually quite bothered. Well, pretty senior officials, both Chinese and Japanese, were essentially saying the relation between China and Japan today are similar to the relation between Britain and Germany on the eve of World War I. And this year, 2014, is the 100th anniversary of 1914 World War I. Now, of course, history doesn't have to repeat itself, but historically, whenever you had the rise of a new power, Germany, World War I, World War II, facing existing powers, or in the case of World War II, Japan facing another Pacific power like the US, eventually conflict has ensued. Now, This time around might be different, diplomacy, economic, financial, trading relations, but the situation in Asia is interesting right now because you have a bunch of countries that have chosen or elected new leaders that are very nationalistic. Prime Minister Abe is very nationalistic. Xi Jinping is very nationalistic. Modi was going to be just elected soon enough in India, is a nationalist. And President Park in Korea is also a very nationalist. And each one of these countries facing major challenges of structural economic transformation. And if they get it right, they grow. But if they get it wrong, if Abenomics fails in Japan, you'll have an economic crisis and a debt crisis. If these reforms in China don't go exactly right, you could have a real hard landing. Modi in India may not be able to do at the national level what he has done in Gujarat because the chief minister in every state are very independent. And Mrs. Park in Korea also faces major challenges. So suppose some of these economic transformation go wrong, then what's going to happen politically? You're going to blame the foreigners. There are a whole bunch of territorial disputes, and eventually some of those tensions in Asia could actually escalate. So I would say that how to have and manage the peaceful rise of China is going to be probably geopolitically the biggest issue we'll have to face in the next 20 years, more important than many other ones. And if things go wrong, the trade links, the financial links, the FDI in Asia could be significantly affected. Already the skirmishes between China and Japan 3 years ago led to a backlash against Japanese businesses. The sales by Japanese firms in China collapsed, FDI slowed down, and so on. So those are the kind of things that probably geopolitically you have to think about.
So I don't want to minimize the animus or nationalism in certain parts of Asia. If you take a kind of parochial example from a trading floor, just to help fix ideas, it's difficult at some investment bank trading floors to get a US-based Chinese trader to sit next to the Japanese trader. That's for real. I mean, that's actually happening on an investment bank trading floor. And if you go to China, or if you go to Japan, you can see some other examples of this. So I don't want to minimize that. And the Chinese are a very big, awesome country. But the fact of the matter is they're also surrounded by another billion people who are not great fans of their potential for expansionism as well. So these are real and serious issues. But I think the World War I metaphor is flawed in 3 ways. First, World War I was importantly caused by a couple misconceptions about how the global economy works. And it was also, as the first point, caused importantly by a leader who was crazy. Kaiser Wilhelm II was crazy. His cousin said when he was 12 years old about Kaiser Wilhelm that he was going to start a global war because he was crazy. I do not believe the Chinese and Japanese leaders are crazy, and that is an important point. The second point is that there was a perception back 100 years ago that the economy was a zero-sum game. Whatever Germany could get was going to be taken away from Britain. Whatever Britain could get was taken away from Germany. That was a colonial-style economy where Germany wanted to expand and other folks wouldn't let them expand. That is a very antiquated view about how the economy works. And if there are any people in the world or any leadership in the world who understand that the economy of the world is not a zero-sum game, it's the Chinese, because they're the ones with the biggest current account surplus in the world. And the country with the biggest current account surplus in the world is the one that has the most to lose from pissing off its customers. As a third point, back in 100 years ago in World War I, people thought that the war would be over in 6 weeks. It'd be like the Franco-Prussian War, where the Germans won one battle, got what they wanted in France, and it was over. There was a perception, therefore, that war was nearly zero cost. And there's no perception like that nowadays. Nobody in China or Japan or Korea or Vietnam or India thinks that war is zero cost. That's a crazy idea, not only because of nuclear weapons, nuclear powers, but also because we have a much greater appreciation, having gone through World War I and World War II, that you can't go fight wars that are zero-sum. So I think the emphasis on some of these geopolitical issues is apt because you see it in your own life, but I don't see any of the fundamental enabling factors to make these things salient for what you'd want to do as an investor or planning for businesses or planning for households.
Can I elaborate on that? I think the probability of a war probably is limited. And I think that the leaders are not crazy, but they are nationalistic. And if economic reform do not occur right, you already see some elements of xenophobia. And the risk is actually that the war is the outcome of actually a policy mistake. I mean, think about what happened in 2010 when that Chinese trawler hit that Japanese Coast Guard. The guy was the captain of the Chinese trawler, was drunk, and he hit the Japanese, and there was a diplomatic escalation, and then the Chinese cracked down on sales of Japanese cars in China, then FDI was affected. So think about what's happening with those islands between China and Japan today. You have hundreds of airplanes, hundreds of ships that are every day going over each other. Suppose a mistake occurs. What's the risk a mistake occurs? Then there is an escalation of something of a limited conflict, and even a limited conflict can have significant consequences. Secondly, on the zero-sum game, during the era of great globalization, people told in 1914, the great power will never fight together because there is trade links, financial links, globalization, and therefore it's going to be a zero-sum game, and everybody's going to lose, right? From this situation. And guess what? Sometimes politics and geopolitics trumps economics. Look at what's happening to Russia. Russia is going to sink into a severe recession, massive capital flight, the currency is falling, the stock market is falling, bond yields going up, but the guys in the Kremlin who want to take over Ukraine have the upper hand, while the reformists and the moderate want to be engaged in the West are shutting up. So sometimes politics, as we know, takes the upper hand when nationalism becomes more important. So it's not my baseline, but I would not underestimate that in the case of the Europeans, they fought 2 world wars, they slaughtered each other. Germany accepted the blame. They built institutions of economic, financial, trade, and political cooperation. In Asia today, these countries are still debating who is at blame for what happened when during World War II. They hate each other, and they do not have the institution of economic and political cooperation. So these are things that probably, short of an outright major war, can lead to conflict rather than cooperation. I think it's a risk to keep in mind.
Let's talk emerging markets, sort of the intensification of problems around the emerging markets, boosted by political issues. What are you most concerned about?
In emerging markets, I think what I'm most concerned about is something I don't understand, which is
the languages they speak.
I barely understand English sometimes. So I think the thing that's been confusing for me is the degree of synchronization in financial markets stemming from what's going on in developed markets, especially Europe and in the US, obviously. So we're talking earlier about the taper tantrum and the degree of spillovers from US monetary policy into other places highlights either for me a degree of vulnerability in emerging economies that was not as fully appreciated as I should have appreciated, or it highlights a degree of financial linkages, spillovers, excess sensitivities that I find hard to understand from a fundamental standpoint. So I think that as there's more heterogeneity in the global economy, if you have this excess sensitivity, you're more likely to end up with some real problems in emerging economies. And that can then feed back into perceptions about the strength of the U.S. recovery. You saw in January, you'd see headlines about what was going on with the SARB, and none of you should know what the SARB is necessarily offhand. It's the central bank in South Africa, but markets were very concerned about whether they were going to be raising rates, and that's a kind of feedback loop that's very hard to understand from a fundamental standpoint. U.S. becoming stronger, thinking about raising rates eventually, more vulnerabilities in the rest of the world, those vulnerabilities making it so then there's some spillover back into developed market asset markets, which then are worried about a catastrophe in some EM economies. So I think I'm both confused and worried by that, because the policymakers aren't necessarily well enough equipped to deal with what's the Buffett phrase, that when the tide goes out, people are not looking so good. So I guess I worry about that. And it's hard to pick out any one economy or pick on one economy, especially when so many of them are making positive strides to reform their economies. But I think you could have real problems. And we've seen examples of that before, like what I mentioned earlier, where Mexico blew up because the U.S. raised rates in 1994.
But within EMG, there's not a specific country you feel more bullish on?
More bullish on? I guess I'm bullish on the Chinese reforms, but not Chinese growth. I think Eastern Europe is very vulnerable to what's going on in Ukraine. I think the Brazilians are having trouble. I think the one that's most likely to do well, both because of what's happening in China and the rest of Latin America, is, like everyone, I think we're quite bullish on Mexico. It's hard to find someone who isn't bullish on Mexico, but EM is not a monolithic block. I think when valuations were low and the world was growing so quickly, it's easy to think of EM as an overall asset class and say, I want to be involved in EM. Now I think you have to be much more choosy. It's a buffet EM, and you have to go and pick and choose in that buffet the things you're going to like, and maybe the top of the heap is Mexico. And if things improve in Russia and Ukraine, Eastern Europe, I think we'll be fine. But the vulnerable countries, those fragile five, I think are if they were fragile with negative real interest rates in the U.S., they're going to be potentially broken like a porcelain doll when real rates go up in the U.S.
Emerging markets.
I agree with Jason on the theme of differentiation. Of course, there are fragile five: India, Indonesia, Turkey, Brazil, South Africa. They have in common twin current account and fiscal deficit, a rising inflation because they were behind the curve for a while, falling growth, and now they all face either parliamentary or presidential elections, creates some political uncertainty. In addition to this fragile five, of course, there's another bunch of countries that are fragile for another combination of financial and political reasons: Ukraine, Russia, Hungary, Argentina, Venezuela, and Thailand in Asia for political reasons. I would say that, first of all, even within the group of fragile ones, you have to differentiate. For example, India, Indonesia, Brazil have done monetary tightening now, double-digit policy rates, compared to South Africa and Turkey. They've done less also in terms of fiscal adjustment. Some countries are actually basket cases, like Argentina. Cristina Fernandez is a lame duck. Whoever is going to be elected in Argentina next year, whether it's Massa or Macri or Scioli, is going to do better policies, and therefore, paradoxically, Argentina might go in the right direction. Secondly, there are plenty of emerging markets that actually have better fundamentals, in Asia, Korea, Malaysia, Philippines, in Central Europe, Poland, Czech Republic, Slovakia, in Latin America, Mexico, Chile, Colombia, Peru, Uruguay, or even in Sub-Saharan Africa. South Africa is not growing very much, but there are plenty of very strong growing economies. So you cannot lump them all together. But if you had to think about themes about emerging markets that are common, I would say three global tailwinds are becoming headwinds. China is not going to grow any longer 10%. Whether it's 7 or 6 or 5 is going to be lower. That affects emerging markets. Secondly, however slowly, the Fed is going to exit QE and zero policy rates. And however slowly, money that went into emerging markets searching for yield are already moving out, and they'll do more so as real rate rise. And three, the commodity super cycle is mostly over, not just because China is slowing down, but also because years of high prices have led to new supply by new producers. So those were tailwinds for emerging market for the last decade for growth, and asset prices now are becoming, however slowly, headwinds. Fourth factor, in the years of easy money and easy policies in advanced economies, zero rates, QEs, money was flowing in emerging markets. So loose credit policy, loose monetary policy, even loose fiscal policy with low interest rates. Now macro adjustment has to occur on the macro side. But fifth and more important factor in EM, in my view, it has been for the last decade, a lost decade, with very few exceptions, say maybe Mexico today, for structural reforms. Market-oriented structural reform that increase potential growth through innovation, technology, competition, a better allocation of resources have not occurred in most of these emerging markets, and many of them have moved actually away from market-oriented reforms towards variants of state capitalism. Look at Russia and China, but also India, South Africa, of course, populist countries like Argentina or Venezuela, but even in Brazil has happened. Things like too much of a role of state-owned enterprise in the economy, too much of a role of state-owned banks in the allocation of credit and savings to investment, resource nationalism, import substitution, industrialization, like in Brazil, protectionism, you name it. Estimates now suggest that the average growth rate in a typical EM probably has fallen 1% in the last decade, in some cases even 2%. So that actually implies that if you look at the next decade and growth and returns in equity market, with tailwinds becoming headwinds, with the macro becoming more fragile in a number of emerging markets, if structural reform were not to occur, then the returns in EM in the next decade may be lower than they were in the last decade. Again, you cannot generalize. Some countries, Mexico and others, are doing reforms. The political economy reform is going to be successful in some EM. It's going to be much more complicated in other emerging markets, but differentiating and picking the better ones from the worst one is going to be important. And the divide that was traditionally, BRICS are going to be the big ones growing fast and the others are going to do less okay, doesn't make sense. Take the BRICS. 3 out of 5 of them this year are going to grow less than the United States, right? Russia, South Africa, and Brazil. And for the last few years, most of the growth of the BRICS was driven by China. And even China is slowing down. And India used to grow 9%. It's barely growing 5% right now. So rather than looking at the big ones, I would look at the ones that are, whether big or small, more chances institutionally, politically, to do the right macro and structural reform that boosts growth and boosts returns to investments.
So I think this is the most important point of the panel, which is if you look back over the last decade or so, what we came to see as a truth was that EM was going to do so well. And these tailwinds turning into headwinds in EM are just fantastically important, because I think a lot of the things that we predicated as investors on continue on our broken business models. And just to simplify the point for me, the idea that you can dig up some stuff in the ground with very expensive equipment, with lots of leverage, and send it in service to a credit bubble in China and not have to pay much for it because the reserve currency set a negative real interest rate, all those paths are broken now. And there's a lot of business models that were built up based upon those paths getting even wider. And so I think Nouriel's point about the 3 out of the 4 BRICS doing even worse than the US this year is just profoundly important. It's much different than what you're used to. So if you take away, I think, one thing from this panel, a lot of things that we said I think are probably broadly familiar to you, but this is a structural, fundamental mega trend break in what people have gotten used to, not only at the Milken panel, but in all these things you've seen over the last decade or so.
Yeah, and the additional caveat I'll make is that, again, as I said, potential growth is going to be key for some of these emerging markets. Some people, of course, worry about a generalized currency crisis, banking, or sovereign debt crisis. And I think the risk of those kind of things happening in some systemic EMs are still low. One, because, of course, they have more flexible exchange rates, so they don't have the city index of fixed rates that were subject to Iran. Secondly, most of them now have a war chest of reserves, so they can face liquidity runs against their government, the banks, their currency, by using some of those reserves. Currency mismatches are much less than they used to be, and therefore risk of a balance sheet effects coming from a collapse of the currency is lower. Debt ratios are rising in the private and public sector, but from low levels. So in addition to risk of illiquidity being low, the risk of insolvency, with few exceptions, is lower. And the banks, however, excessive credit growth, have more liquidity, more capital, and are better regulated than in the past. However, excesses have occurred in financial system, in the corporate sector, and some of these countries look fragile. So I would say a risk of a typical EM crisis maybe some of the basket cases. Of course, a currency crisis can occur in Argentina, in Venezuela, in Ukraine. A sovereign debt crisis can occur in these countries, but those are the exception. The big ones have massive structural reform challenges, but the risk of an outright financial crisis like the one we saw 15 years ago probably is lower. But that's is not great comfort, because if potential growth is going to fall sharply because you don't do the structural reforms, then returns on risky assets are going to be very low in the next few years, regardless of the risk of a tail financial meltdown.
Let's turn our attention to Russia, Ukraine. You and I sat down a couple days ago, and on a 1 to 10 scale of how catastrophic things are or can get, you put it at a 7 and only getting hotter. Mm-hmm. Where do you sit, Jason, on the situation in Russia right now?
A 1 or a 2. I mean, so maybe I have a somewhat different perspective, and I don't want to sound like an apologist for a cruel dictator. On the Crimea bit of this, which I guess most people think of as the rearview mirror, the Russians stole Crimea fair and square in 1793, before the U.S. was even properly a country. And the fact that it was given back by Khrushchev to the Ukraine, maybe because of a woman, if I remember correctly, is incidental to the ethnic and historical makeup of that population. It's an enormously important strategic area for the Russians. So it's their warm water port, they have to have it. So I guess I'm not surprised that they would move in such an aggressive fashion to reassert their control over Crimea. When it comes to the Ukraine, I'm sure the Russians' goal is to destabilize in order to control. I don't see why that destabilization has great spillovers into the global economy, the kinds of things that you in the audience would care about in your daily or professional lives. Yeah, if you're a CEO of an Austrian bank, I think you're going to have some serious trouble. Or if you're sitting there in Hungary or Poland, you may have both strategic and some economic worries. But as a very, very crude approximation, the elasticity of German GDP with respect to Russian GDP is about 1 to 20. Which means that if the Russian economy collapses by 10%, which would be absolutely catastrophic and more than anyone's forecasting, the worst forecast for the outcome of the Russian economy this year is Danske Bank at -4%. So let's more than double that. The elasticity with respect to their closest major trading partner with Germany is 1 to 20, which means that would shave just a few tenths off German growth. So you're not talking about something more than even 5/10 off German growth out of something that would be the equivalent of almost the Great Depression in Russia. Sure, there could be some disruptions with regard to energy and so forth, but I don't see these things as major geopolitical events. Maybe it's having some effect on asset markets, but and maybe sometimes investors are a little bit too optimistic with regard to some tail risks, but I just don't see how I can get as an investor too excited about what the Russians are exerting in Ukraine, so long as they don't turn it into a real shooting war. And I'm not sure that there's anyone out there putting that at their base case. I mean, Nouriel talked earlier about China and Japan getting into an accidental shooting war. Well, sure, if you're talking about accidents and shooting wars between major powers, then perhaps I'll get more worried. But I consider myself maybe at more of an outlier level on concern for this. And I think if we return in 1 year's time, this will not be something that will have been a major issue for the global economy.
Are you not concerned about increased sanctions in turn hurting the European economy?
As I say, on the individual level, if you're a CEO of an Austrian bank, I don't think you're going to be very happy if they freeze many of the outlets of Russian banks into the global economy. And by the way, Treasury has gotten very, very good at this. Yesterday I met with the Secretary at Treasury, the Assistant Secretary who's in charge of dealing with terrorism and terrorism finance and is in charge with imposing these sanctions. They know exactly how to put pressure on folks, and this pressure will be tuned up slowly over time. And I actually, could be some cheap talk in a negotiation, but I believe Secretary Liu when he says that they will begin to tune these things up, and they know how to do it. So I think in the micro, it's an important issue, but in the macro, when you look and you take a broader step backwards, unless you can generate some kind of severe overreaction and panic in markets owing to perhaps an oil shock. I mean, if oil goes up to $150 a barrel, maybe that's a transmission mechanism that can affect the economies more. But as I say, just based upon what's been in the data before, Russia, by the way, over the last 20 years has not been an economy that's always performed that well. And you know what? The global economy has managed to muddle through nonetheless.
Well, I would say the following thing. If you take a baseline scenario, that is still my baseline, in which the tension linger, but is short of a hot war between Russia and Ukraine, so there's a Cold War going on between the West and Russia, I'd agree with the baseline that Jason has described. But think about the following scenario. Suppose that now this Cold War escalates into a real hot war. And what do I mean? That the Kremlin, for a series of reasons, decides not just to destabilize the eastern provinces of Ukraine, but actively then send troops. There is a question when the tanks of Russia are going to cross the border. And in the last few weeks, I would say the escalation has led to a rise in the probability that an actual event of that sort would occur. First thing is going to happen is going to be a massive escalation. We've gone from level 1 to level 2, going to go to level 3 type of sanctions of the West against Russia. Secondly, Russia is going to counteract with a variety of economic and financial sanctions. Third of all, what's going to happen is that there is an active war in eastern Ukraine. While NATO, of course, cannot militarily intervene, the US had said so, the minimum that the West has to do is at least to provide weapons to the government in Kiev with support. And there'll be a massive provision of weapons by the US and Europe to the government in Kiev, because otherwise the risk that Russia takes over not only the first half, the eastern one of Ukraine, but all of Ukraine will be a significant risk. The least we can do, otherwise the credibility of the US of saying, we already lost the credibility in Syria, in Libya, now in Ukraine. Now US says we're pivoting in Asia. All our allies in Asia are saying, look what happened in Syria and Ukraine, you're a bunch of wimps. Unless we do something to support the guys in Kiev that we believe are in favor of us, then we lose all credibility. So at that point, you have support militarily of the West, weapons, not troops, of the government. Then you have a real hot war, and it escalates. And in that scenario, the probability that Russia decides to cut off the supply of gas, not only just to Ukraine, but also to Western Europe, becomes a meaningful risk. Because at that point, Russia is going to use the most powerful sanction that they have in their power, that is essentially supplying less gas to Europe. And then you have an oil or energy supply shock in price and quantity, and the Eurozone recovery is just barely starting. And I would say that the last thing the Eurozone needs is to having not only a financial shock, but a major economic shock from having a shock to the supply of gas. And in a situation like this one, markets that so far have been still risk on, still believing that this Russia situation with Ukraine is noise, we don't care about it because the systemic links are minor, risk-off episode can occur just because people starting to get nervous, right? It happened before, right? When this escalation occurred, there were days in which financial markets were in risk-off mode. And this was just with a Cold War. Let's talk about the scenario in which there is a real war. So in that scenario, I don't know whether it's a 10% probability or 20 or 30. Certainly that probability in the last few weeks is rising. The economic, financial consequences, the risk of sanctions, counter-sanction, a gas embargo, and panic and risk-off in financial market becomes a bigger risk. And at that point, the biggest victim, leaving aside Russia and Ukraine, is going to be the Eurozone. The last thing the Eurozone today needs after a recovery is already anemic, fragile, and uneven, is going to be a gas supply shock, is going to tip it back into a recession. Again, I don't know which probability to assign to this downside scenario, but is rising as a risk.
So let me say three things to wrap up, at least on my side. One about Russia, one about the U.S.
Africa. Do you want to?
No.
It's just the one place we haven't.
So I'm gonna get to one place we didn't mention in just a second. So let me do something on Russia. Let me do something on just a bit broader on geopolitics, and then I'll get to the broader point about something that we didn't mention. First, the thing about Russia reminds me of a scene in this movie that's a little bit older, so some of you may not know it. It's a scene from a movie called Blazing Saddles. There's a scene where Cleavon Little, in order to intimidate his captors, puts a gun to his head and says, "Stop or I'll shoot." And I'm kind of reminded of that scene by the discussion about Russia, which is the idea that Russia is going to cut off the only thing that makes money for their country to Europe just strikes me as not that credible. It's a bit like saying to Cleavon Little, "I'm going to shoot myself in the head, so you have to stop." So I don't rank that as a very high concern, and certainly it's not an accident that's waiting to happen in my view. I think there's a broader point though that does worry me. The broader point, and you saw it in a Wall Street Journal headline story today, which is that the American people and America itself, and certainly in the way that Obama is kind of playing his geopolitical cards, America is withdrawing from the world. And we don't have lots of experience with how that is going to play out. And that may be a very, very destabilizing thing in places that we haven't talked about, whether it's North Korea, Pakistan, what have you. I'm not particularly concerned about some of the ones that we've mentioned, but the U.S. generally withdrawing from the world is something that we haven't seen, and is something that should be on the kind of your top five worry lists if you're talking about inchoate worries. Stephanie mentioned that we haven't mentioned Africa. What's really funny is that we really haven't talked about Europe. So Europe in people's mind share is now below Africa. And so you can play that in one way or another, which is that we just have Europe fatigue, or you can
Europe
put it
talked out.
That is exactly right. You're Europe talked out such that you'd prefer to talk about Africa than Europe. So I just think that's an interesting point, and you can spin that in a couple different ways, which is just the fatigue point. I would spin that potentially in a maybe slightly positive way, which is that this conference has been dominated over the last few years. I sat, for example, 2 years ago on a panel where Nouriel predicted that Greece would exit by the end of the year, and other countries were probably going to exit.
Got to call them out. We're almost done. Everything went so well. Had to call you out right before we were done.
I got that one wrong. First one to admit.
So, but now we're not even talking about Europe. So ask yourself, is that a plus or a minus for thinking about the answer to Stephanie's first question, which is how you rank on a scale of 1 to 10 your view about the global economy? And I guess after listening to myself and Nouriel during the panel, I've decided that I have to, in my last comment, revise my view about whether we're 1 to 10, and I'll revise it up to at least a 7.
Wow.
Why do I worry? I mean, I think the global economy is recovering. As I said, think about the scenario in which China has a harder landing rather than a softer landing. Think about the scenario in which the Fed may make a policy mistake. Think about the scenario in which the situation in Ukraine and Russia evolves in a direction that is not ideal. Think about some of the big emerging markets that are fragile. Think about the fact that Abenomics may fail, may succeed, may fail. And about Europe, I agree. Thanks to whatever it takes, OMT, ESM, and all the other policy of the ECB, the risk of a breakup, the risk of loss of market access by Italy, Spain has been reduced. But think of it. Potential growth in the Eurozone is low because structural reforms are occurring too slowly. The recovery is extremely anemic and uneven, and unemployment rate is going to remain very high for the Eurozone, 25% in Spain and Greece, 50% among the young. Debt ratio, private and public, are still rising in spite of adjustment because the denominator, nominal GDP, is barely growing. Italy has a public debt of 130% of GDP and rising. And the improvement in external competitiveness has been partly cyclical, collapse of imports. Internal devaluation has occurred in some of these countries, but not in Italy and France. The euro is too strong. There is still a credit crunch. Banks are deleveraging, contracting credit. The QR and the stress is going to take them to the end of this year until they recap. Therefore, the banks are still deleveraging. There is austerity fatigue in the periphery. There is bailout fatigue in the core. The EU parliamentary election might lead to a bunch of populist radical parties of the right and the left being in greater strength. And therefore, in the short run, yes, I agree, the Eurozone risks are lower, but medium long term, whether you look at Italy or Spain or Portugal or even Greece, I'm not sure that they are out of the woods. I mean, take even Greece alone. Are we sure they're not going to exit? By the end of this year, they'll have a presidential election. If they are not able to elect after 3 votes, they go to parliamentary election. And Syriza has enough votes to block the voting of a new president. If they go to new election, Syriza right now is #1 in the polls. If they become #1 party with a majority plus, they become the leading government. Is there a set of policy that is acceptable to the Troika, that is acceptable to Syriza and Tsipras? Most likely not. So today, Greece looks out of the woods, regaining market access. A year from now, with Tsipras prime minister, I'm not sure what's going to happen in Greece. So I think that the markets are becoming a bit too condescending. The spread reduction in Italy, in Spain, in Greece, in the rest of the peripheral Eurozone doesn't look like it's consistent with fundamentals of public debt to GDP in Italy at 130% and rising. So I think that's one of the frothiness I see in financial markets. So I do worry about the Eurozone.
We're going to leave it there. Jason Cummins of Brevan Howard, thank you so much for joining us. Dr. Nouriel Roubini, thank you. Thank you.